Hello, this is the 27th episode of What Would Peter Lynch Do that explores the wisdom of legendary investor Peter Lynch. Last time, a listener explained the PER and indicators for judging stock prices. This time, please explain EPS in more detail. Forward EPS is used to give a multiple to valuations to see how much the stock price will be or rise in the future, but I don't know what that means. Can you explain it to me? Oh. Okay, that's a really great question, and honestly, it's one that trips up a lot of people when they first start investing. Understanding EPS, earnings per share, and especially this idea of forward EPS, well, it's absolutely key to figuring out what a company might actually be worth. So today, we're going to really dive deep into these concepts. We'll explain what they mean, why they matter so much, and crucially, how they link up with stock valuation. We'll make that connection clear, and naturally, we'll weave in Peter Lynch's perspective. Let's get into it.
Yeah, absolutely. And this is so important because, understanding a company's health, its real potential, it isn't just about like looking at a stock chart.
Right.
It goes right back to Peter Lynch's core idea. You have to understand what you own. So we'll break down these metrics step by step, show you how they tell a story about where a company's been, but maybe more importantly, where it might be heading.
Perfect. So let's start right at the beginning. EPS.
Yeah.
How would you explain earnings per share to someone, just starting out?
Okay. So EPS, earnings per share. At its heart, it's pretty simple. It's the company's net profit, basically, divided up among all the shares of its stock. Think of it like this. For every single share out there, how much profit did the company actually make? The calculation is net income minus any preferred dividends, and then you divide that whole amount by the number of common shares outstanding. That gives you the profit per share.
Right. And just to clarify those bits for everyone listening, net income, that's the profit left over after all the costs are paid, materials, salaries, rent, taxes, interest, everything. The bottom line. Preferred dividends, those are payments that go to a special class of shareholders, preferred shareholders, before us common stockholders get anything. And number of common shares outstanding, that's just the total number of regular shares floating around on the market that people like you and me can buy and sell. Usually an average number over the period.
Precisely. So why is this EPS number such a big deal? Well, a few reasons. First, it's a really direct measure of profitability. If EPS is going up consistently, that's generally a sign the company is getting better at making money per share. Healthy sign.
Okay.
Second, it's absolutely fundamental for valuation. We talked about the PER, the price to earnings ratio last time. Well, EPS is the E in PER. You can't calculate PER without it. It's a cornerstone for investors.
Right. Essential for that key ratio.
And third, a higher EPS suggests the company could potentially pay out more in dividends. That doesn't guarantee it. The company might decide to reinvest the profits instead, which can also be good. But it shows they have the capacity, the earning power, to return cash if they wanted to.
That makes sense. Now, I know there are different flavors of EPS, too. There's basic EPS, which sounds like the standard calculation we just did. But then there's diluted EPS. Why look at that?
Good point. Diluted EPS is, let's call it a more conservative look. It considers what might happen if all potential shares were actually issued. Think about things like stock options given to employees or bonds that can be converted into stock. If all those potential shares suddenly became real shares, the total number of shares would go up, right? And if you divide the same net income by more shares, the earnings per share goes down. So diluted EPS shows you a sort of worst-case scenario for earnings per share if all that potential dilution happens. Investors like it because it's more cautious.
Got it. A more conservative view. Okay, so that's EPS, looking back at what was earned.
Oh, yeah.
But our listener specifically asked about forward EPS, which sounds like it's about the future.
Exactly. That's the key difference, time. Forward EPS is an estimate, a projection, of what analysts expect a company to earn per share over a future period, usually the next 12 months.
Oh.
It's really important to remember it's a forecast. It's not based on historical results like the standard EPS, which we often call trailing EPS or TTM EPS, for trailing 12 months. Forward EPS is all about looking ahead.
And that future focus is critical in investing, isn't it?
Oh, absolutely critical. The stock market is fundamentally forward-looking. People buy stocks based on what they think a company will do, not just what it has done. Think about it, are you investing based on last year's news or next year's potential? Forward EPS tries to capture that future potential. It's kind of like the market's collective best guess about future earning power. And that's what really drives stock prices in the long run, expectations about the future.
Okay. This perfectly leads into the listener's main point. Forward EPS is used to give a multiple in valuation to determine how much the stock price will be in the future or how much it will increase. Let's unpack that sentence. So, valuation, that's just trying to figure out what a stock should be worth. It's fair price. Are you paying too much, too little, or about the right amount right now?
Right.
And a multiple, that's usually a ratio, like the PER we know, that we apply to something like earnings to get that valuation. So when we say give a multiple, we mean taking an appropriate PER multiple, maybe based on industry peers or growth expectations.
And multiplying it by the earnings per share figure.
Okay. So how does forward EPS fit into that calculation?
Well, this is where you get the distinction between, say, a trailing PE and a forward PE. Trailing PE uses the EPS from the past year, but forward PE uses that estimated forward EPS for the next year. The formula is simple. Forward PE. Current stock price estimated forward EPS. Investors often lean towards using the forward PE because, again, investing is about the future. It helps answer, is today's price fair compared to what we think the company will earn next year?
Let's use an example. That always helps. Say we have company A. Current stock price is $100, and its trailing EPS from last year was $5. So its trailing PER is 100 divided by 5, which is 20 times.
Okay.
Got it.
Trailing PER of 20.
Now, analysts look at company A and say, wow, they've got this amazing new product coming out. They expect profits to really jump. So their estimate for next year's forward EPS is, let's say, $10 per share, double the past EPS.
Okay, big growth expected.
Right. Now, how do we use that forward EPS? Well, we need to decide on an appropriate PER multiple for a company with that kind of growth potential. Maybe similar fast-growing companies in its sector trade at, say, 25 times earnings.
A reasonable assumption for a growth company.
So we take the estimated forward EPS of $10, multiply it by that appropriate PER multiple of 25 times. And what do we get? 10 times 25 equals $250.
Right.
So based on future expected earnings and a suitable multiple, the fair stock price could be $250. But the current price is only $100. That suggests the stock might be significantly undervalued with a lot of potential to rise as those future earnings materialize.
That example really shows the power, doesn't it? Forward EPS lets you anchor your valuation in future expectations, not just past performance. It's how analysts often set target prices. They estimate future earnings, forward EPS, and multiply by what they think is a fair multiple. Forward PE based on growth, risk, etc. It's all about trying to gauge tomorrow's value today.
Okay, we've gone through the details, but sometimes it helps to simplify things even more. Let's try an analogy to really nail the difference between EPS and PER for our listener, because they're related, but they tell you different things. Let's think about EPS first. Simple question. For each share, how much profit did the company make? Imagine that pizza shop again. EPS is like asking, how much profit did I make from selling just one pizza? It's purely about the shop's ability to make money on its core product. Higher profit per pizza, better business generally.
Right, it's the earning power.
Than PER. The question here is, relative to the profit it makes per share, how much do I have to pay to buy one share? Back to the pizza shop analogy, PER is like asking, okay, this shop makes X profit per pizza. How much does it cost me to buy the whole shop compared to that per pizza profit?
So it's comparing the price tag of the shop to its profitability.
Exactly. So if you have two pizza shops, both making the same, say, $2 profit per pizza, same EPS, but shop A costs $20,000 to buy and shop B costs $40,000. Shop A has the lower PER. It's cheaper relative to its earnings per pizza.
Makes sense. So PER is about the stock's price relative to earnings.
Precisely. So the core difference boils down to this. EPS shows the company's fundamental strength, its earning capability. How good is it at making money? PER shows the stock's price tag is the current market price, high or low, compared to that earning capability. You could have a company with amazing EPS, a real money-making machine, but its PER might be sky high because everyone knows it's great, and the stock price has been bid way up, maybe too high. Or you could have a company with decent but not amazing EPS, but its PER is really low. Maybe the market is overlooking it. That could be interesting.
Yeah, and that's exactly how smart investors use them together. It's usually a two-step process. First, you look at EPS, particularly its trend. Is it growing? To answer. Is this actually a good business? Does it make money consistently?
Step one, check the engine.
Right. Then, step two, you look at the PER to answer, okay, it's a good engine, but is the current price tag reasonable or is it overpriced? You're looking for quality first, EPS, then checking the price, PER. Finding a great product, then seeing if it's on sale.
Which leads us perfectly to Peter Lynch, because he was all about finding those great companies, especially growth companies, but crucially, buying them at reasonable prices. His book, One Up on Wall Street, is full of this stuff.
Oh, absolutely. Peter Lynch saw consistent EPS growth as, the true vitality of a company. He believed, fundamentally, that stock prices eventually follow earnings. If a company keeps making more money per share year after year, its stock price is likely to go up over the long term. For him, finding companies with a strong track record of growing EPS and, importantly, good prospects for future EPS growth, that forward EPS idea again, was the absolute key to finding those multi-bagger growth stocks he was famous for.
And what about PER? How did he view that?
He didn't just look at PER as high is bad, low is good. He saw it more as an expectation premium. A high PER suggested the market had very high expectations for future growth baked into the price. A low PER might mean low expectations, or maybe it was just overlooked. He strongly warned against comparing PERs blindly across different companies or industries. A high PER could be totally justified for a rapidly growing tech company, he'd say, whereas the same PER would be ridiculous for a slow, steady utility company. Context was everything. You had to compare PER to the company's growth prospects.
Which is exactly why he championed the PEG ratio.
Precisely. The price-earnings to growth ratio was Lynch's brilliant way of putting PER into context. It directly compares the PER to the company's expected earnings growth rate. The formula is PEG = annual EPS growth rate %. It elegantly connects the price you're paying, via PER, to the growth you're getting via EPS growth.
And this ratio gives you a much clearer picture, doesn't it? Lynch had those famous rules of thumb.
He did. Generally, he felt a PEG ratio below 1 was potentially attractive, suggesting the stock might be undervalued relative to its growth. A PEG below 0.5. That was exceptionally good in his book.
Very attractive.
Conversely, a PEG over 1.5 started to look potentially overvalued. The price was getting too high even for the expected growth.
And think about why this works. We talked about that company with a low PER of 10. Looks cheap, right? But if its EPS is only expected to grow at 5% per year, its PEG is 10 divided by 5, which equals 2. According to Lynch, that's potentially overvalued despite the low PER.
Exactly. The low price doesn't compensate for the lack of growth.
Then take the other example. A company with a high PER of, say, 30 looks expensive. But what if its earnings are expected to grow at 30% per year? Its PEG is 30 divided by 30, which equals 1. Lynch would say that's a potentially fair price, maybe even attractive, because the high growth justifies the higher PER.
Let's nail it with one last comparison. Company A PER of 15, but analysts expect 30% annual EPS growth. Its PEG is 1530 = 0.5. Very attractive, right?
Looks great by Lynch's standards.
Now, Company B PER of 10 looks cheaper, but expected EPS growth is only 5%. Its PEG is 10, 5 = 2, potentially overvalued. So even though Company B has the lower PER, Company A is actually the better value proposition according to the PEG ratio because its growth is so much faster. You're paying less for each unit of growth.
It's such a powerful concept. And of course, Lynch didn't just look at numbers. His approach was much broader. He always talked about invest in what you know, understanding the business from your everyday life.
The local knowledge advantage.
He believed in visiting stores, talking to management, really kicking the tires, understanding the long-term story, classifying stocks, and being patient, not getting scared out by market dips if the company's story was still intact.
Definitely. So, to wrap it all up, Lynch's method, in a way, used these tools sequentially. Use EPS to check the company's fundamental earning power and growth trend. Use PER to gauge the current market valuation, but with caution. And then use PEG to really see if that price is reasonable, given the expected future growth. His goal wasn't just cheapness, it was finding great, growing companies at prices that made sense relative to that growth. That's the heart of it.
I will say a word from Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom.
You know, it really is. This idea of looking past the surface price or immediate perception like a stock's current PER to understand the underlying quality, the earning power or intrinsic value, like EPS, and especially the potential for future growth. That applies everywhere. Are you evaluating a job just on salary or on the skills you'll gain in future career growth? Are you choosing a project based on immediate ease or long-term impact? It's about assessing true worth and future potential, not just the superficial price tag. It's a deeper way of evaluating things, just like Lynch evaluated companies.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.